Yeah, I think you've hit a lot of the key points there, Karen. You know, obviously, J.P. Morgan and Wells Fargo are going to be reporting later today. Two very different banks. I mean, J.P. Morgan is a fortress balance sheet, high quality name. Um, I think they're, if you talked here about looking at their net interest income and net interest margins, a little bit of pressure there, expected to kind of fall off a little bit. But that's because they're heavily into the kind of the construction and industrial type loans with a variable rate, and they're more adversely affected. Banks like regional banks who have a lot of real estate on their loans, they should be helped out a little here by the lower rates and the steepening curve. The whole sector, by the way, should be helped out by the steepening curve. This is something we've been waiting for years. As interest rates have come down on the front end. I think we've got a record inverted yield curve here for several years. And as that comes down, that should benefit banks. Of course, the other flip side of that is the economy itself. The consumer seems to be doing okay, as you talked about earlier. The jobs picture is still very healthy. You get a lot of choppiness in the data that you've been talking about between inflation, jobs, and so forth, and you can expect more of that, more volatility. But if we do get that soft landing, if we do get that further decreases in the front of the curve, we can expect to see the banking sector do very well.
Let me pick up on that point then around the front end of the curve. Does it matter if we don't get follow-up rate reductions from here? I mean, the market was sold a narrative 50 basis points. It's not an emergency move, but it is a move to bring us back closer towards some sort of neutral rate, and there should be follow-up rate reductions. Now, the hot data has one of the Fed members at least suggesting maybe a pause is the state of play. Does that complicate the appetite for loan growth from here?
Well, it certainly will inhibit further loan growth, but look at the flip side of this. If the Fed's holding the rates higher, that's because the economy is going to be stronger. It's two sides of the coin here. The other thing is, the markets, and you look at futures right now, and you look over them at the beginning of the year, the Fed fund futures have been looking for cuts over the last year. I think at the beginning of the year, there was something like 6 to 8 cuts priced into that futures curve, and is continually getting pushed back here. The economy continues to still hum along with GDP growth around 3%. So, things aren't too bad. So obviously there's growth that you're looking at. The other key metric here when you're looking at banks is valuation. When you look at the S&P 500 from the US perspective here, you're looking at earnings growth, right? And earnings growth are expected to be a little bit over 10% for this year, 2024, and in 2025, about 16%. That's a pretty high figure given the long-term average is 8.5%. What we're worried about is some of these expectations are going to have to come down for growth. And I said, the growth is one side, the other side is valuation. When you're looking at the S&P 500, the banking and energy sectors, actually the financials and the energy sectors, are your most attractively priced sectors at this time.